press the bell icon on the YouTube app and never miss another update.
So what is the format of the statement of profit and loss for an Ind AS compliant company? Your first head is revenue, then we report other income, then we report total revenue, then we have a head for expenses, then we find out what is the profit before exceptional items, then we have a head for exceptional items, and finally you arrive at the profit before tax. After that, your next head is tax expense, and this head of tax expense you break it into two. The first one we refer as current tax, and the next one that we refer is the deferred tax. So the objective of this episode is basically to understand what exactly is current tax, what exactly is a tax expense. What is current tax? It's a very simple concept. Whatever income tax that you are supposed to pay for the current year, that will be understood as the current tax. So just find out that for the current year, what is the applicable assessment year? As per that assessment year, how much income tax you are supposed to pay? The income tax that you are supposed to pay for the current year, consider that as the current tax. This is nothing but the age-old provision for tax. What we were calling as provision for tax earlier, we are now calling it as current tax. So, when it comes to current tax, let us say you are preparing your balance sheet on 31st March 2020. So for that, my accounting year, when you say I am preparing the balance sheet on 31st March 2020, that means your accounting year is 2019-20. For this, we should identify what is the applicable assessment year. Right? Income tax is applicable on the basis of the assessment year. So what will be the assessment year? Obviously the assessment year is 2020-21. So whatever are the tax laws applicable for the assessment year 2020-21, that tax law should be considered for determining the current tax. So what are the incomes which are taxable in this assessment year? What are the expenses for which deductions will be available in this assessment year? Based on those tax laws, find out what is the taxable income. And on that taxable income, how much tax is payable? That is your current tax. To find out what is the amount of tax payable, I will require the tax rate. So just ask yourself that for the assessment year 2020-21, what is the tax rate? Let us assume for simplicity that the tax rate is 35%. So whatever is your taxable income, multiply that by 35%. Whatever figure you are getting, that is nothing but the provision for tax. That provision for tax is nothing but the current tax. And it is this current tax that will be reported in the statement of profit and loss. In case if there are any surcharges, in case if there are any cesses, add the surcharges, add the cesses, and then whatever is the final tax rate, use that tax rate to determine what is going to be the income tax payable. Income tax payable for the current accounting year, I will call that as the current tax. The next concept is for the deferred tax. What is deferred tax? That we have already discussed at a greater length earlier, so I am not getting into it. We know there will be some taxable temporary difference, there can be some deductible temporary difference. This taxable temporary difference will result into additional tax in future, and deductible temporary difference will result into savings in tax in future. We use the word future, so it is not going to affect our current year, it is going to affect our future year. Let us assume for simplicity that it is going to affect the next year. So let us say I am having a taxable temporary difference, or let us say I am having a deductible temporary difference on which I am supposed to recognize the deferred tax. Now, this taxable temporary difference or the deductible temporary difference, it will affect my accounting year. Let's say it is going to affect my accounting year 2020-21. So as on the balance sheet date, I am of the view that I will be able to save tax in the next year, or I will have to pay extra tax in the next year. By next year, I mean the accounting year 2020-21. Now for this accounting year 2020-21, what will be the applicable assessment year? The applicable assessment year will be 2021-22. So when you are calculating the deferred taxes, you are supposed to consider the tax laws of the applicable assessment year. See, tax rate for the current assessment year is 2020-21, but 2020-21 is not the assessment year in which you will be realizing the deferred taxes. The deferred taxes are going to get realized in the next year or maybe years. And that is the reason we have to be careful when we are choosing the tax rate. This tax rate of 35% is for assessment year 2020-21, but not necessarily for the assessment year 2020-21-22. Let's say, for example, you are already aware, that what will be the tax rate for the next assessment year. If you are already aware what will be the tax rate for the next assessment year, use that tax rate for computing the deferred taxes. For example, let us say we are already knowing that in the next assessment year the tax rate will be 30%. You are allowed to use that tax rate to determine your deferred taxes. Again, very quickly. Current tax is for the current year. Current year's assessment year will be considered. I'll use that tax rate and find out my current tax. When I am calculating my deferred taxes will not affect current year. My deferred taxes will affect subsequent years. So you have to use the tax rate which is expected to apply in the next year. So if you are already aware that what will be the tax rate for the next assessment year, you can use that tax rate for the purpose of computation of deferred taxes. Here we have a concept of what is known as legislation already enacted or substantively enacted. This is the concept that we are supposed to use at the time of selecting the tax rate which is applicable for the deferred taxes. So, is the legislation already enacted or substantially enacted? You have to see this with reference to the balance sheet date. So, when you are preparing your balance sheet on 31st March 2020, are you already aware what will be the tax rate for the assessment year applicable for the next year? If that tax rate has already got enacted or substantively enacted, you may use that particular guidance. Now, legislation is what enacted means. It has whatever are the legal formalities which are required, all the formalities have been fulfilled. If all formalities are fulfilled, I'll say it has already got enacted. If it has already got enacted, it will be that much easier for me to select the tax rate. But at times the legislation is not 100% enacted, but to a large extent it has got enacted. Then you have to apply judgment, and on the basis of applying your own judgment, you will have to find out what is the applicable tax rate. Let's try to understand this with a certain example. We know that every year, right, in the month of February, the government of India presents its budget. So in February 2020, the government must have presented its budget. The budget proposals are never for the immediate assessment year. The budget proposals are always for the next assessment year. So whenever any proposal has been discussed on the budget of February 2020, it will not affect my assessment year 2020-21. The budget of February 2020 will affect my assessment year 2021-22. So let us say one of the budget proposals which is announced by the government in the February 2020 budget is that from next year companies will, by next year I mean the next assessment year, by the next assessment year companies will pay tax at 30%. So this is where the announcement is made by the government that the tax rate for the next assessment year is 30%. Now, the moment the government announces that the tax rate is 30%, it does not mean that the legislation has got enacted. We know what is the process that is followed in India. Right? First of all, in February 2020, the budget proposals will be announced. Then the finance bill will be discussed and debated in the Lok Sabha. Then the Lok Sabha will pass it. Then it will go to Rajya Sabha. It will be discussed in Rajya Sabha. Then Rajya Sabha will pass that particular bill. Then it will go to the President. The President will give his or her assent. Then it will become a law. And finally it will be notified in the official gazette. Then and then only we can say it has now become a finance act. So there's a pretty long legal process which is there. Now the question that arises is that once the government announces that in the next assessment year the tax rate is 30%, should I use 30% for calculating the deferred taxes, or should I continue using 35% for the calculation of deferred taxes? Now, before the balance sheet date, or let us say up to the balance sheet date of 31st March 20, if the entire process gets completed, Lok Sabha, Rajya Sabha, President assent and the official gazette. If everything gets completed on or before 31st March 20, then the tax rate of 30% has already got enacted. If it has already got enacted, go ahead and use it for the calculation of deferred taxes. But we know this is not really going to happen. It takes a lot of time. Normally it has been observed that the budget which is presented in February, it is sometime in May that it will become a finance act. So it's quite possible that on the balance sheet date, the finance act is still not notified, but it has been substantively enacted. Substantively enacted means the budget has already been discussed in the Lok Sabha. There is a particular company which is of the view that once the budget has been discussed and passed by the Lok Sabha, after that whatever is left is legal formalities. Because once the Lok Sabha passes a money bill, we know it has to be passed by Rajya Sabha. Once it goes to the President, rarely it has happened that the President says no, that I will not give my assent, and hence there is a particular company which is of the view that the moment it is passed by the Lok Sabha, it is substantively enacted. So, by the time I prepare my balance sheet on 31st March 2020, the budget has been passed by the Lok Sabha. So, as a company, I feel that it has been substantively enacted. And that is the reason I will like to use 30% as the tax rate for deferred taxes. I am allowed to do so. But there might also be some another company which is arguing that no, till it does not become a finance act, I will not consider it. And that is the reason, if you are of the view that it has to first become a finance act and only after that I will use the tax rate, then such company will calculate deferred taxes not at 30%, but it will calculate at 35%. So different companies may have a different view that what exactly is substantively enacted. Ind AS 12 provides no guidance with respect to this. And that is the reason we are leaving it to the judgment of the company. Ind AS 12 rather says that every company should develop an accounting policy that when will it consider it to be substantively enacted, and then you should follow that accounting policy consistently. For example, as a company, I take a stand that the moment this particular finance bill is passed by the Lok Sabha, I will consider it to be substantively enacted. So I decide this as my accounting policy. So whatever future tax rate is there, I will consider that for calculating the deferred taxes. Or as a company, I decide my accounting policy is that only when it is notified in the official gazette, only after that I will consider it to be an applicable tax law. Then if this is my accounting policy, then I have to wait till all the legal formalities have got completed. So in that particular situation, I will not use 30% for calculating the deferred taxes. I will use 35% for the calculation of deferred taxes. As you can see, 30%, 35%. This can bring about a material difference. So if as a company you come to a conclusion that there will be a material difference, you should provide a disclosure for the same. And finally, what do we mean by tax expense? As you can observe on the board, when I am preparing my statement of P&L, I am showing current tax and deferred tax. The sum total of current tax and deferred tax, that is what is understood as a tax expense. So when you say tax expense, add up your current tax and the deferred taxes. Yes, it's also possible that your deferred tax is actually a deferred tax asset. So it's very much possible that my current tax is 10,000, but I have a deferred tax asset of 12,000. See, current tax will be debited to the P&L and deferred tax asset will be credited to the P&L. So in this particular situation, my current tax will turn out to be negative 2,000. If the tax expense is negative, we call it as tax income, or you may even call it as tax savings. And accordingly, it should be reported in the statement of profit and loss.
Press the bell icon on the YouTube app and never miss another update.